Record levels of inflation are impacting consumers across the board, pushing prices up for housing, energy and food. So many are anxiously asking, when will inflation start to go down? Determining when inflation rates will start to go down is not an easy task, and the Federal Reserve has recently expressed concern that high inflation will become entrenched. But it can be helpful to look at historic periods of inflation to get a sense of what to expect. How long periods of inflation typically last? The length of inflation cycles in the past have been different, depending on the root cause, says Art Hogan, Managing Director and Chief Market Strategist at B. Riley Financial. The longest period occurred from the mid-1970s to 1980s and lasted about a decade, he says. A much shorter period of inflation occurred from July 2008 to August 2008 when gas prices skyrocketed. The root cause of the inflationary period we're experiencing now was the reopening of the economy before the supply of goods and services could increase to meet demand, Hogan says. Other geopolitical issues such as Russia invading Ukraine, ongoing supply chain bottlenecks and higher energy prices also contributed to soaring prices. There was a pandemic for 2 years where people consumed far more goods than services, Hogan says. The manufacturers weren't able to meet the demand since some were not reopened and could not catch up. The increase in demand for personal goods was the catalyst, he says. Supply could not meet demand. We could not get all the stuff we demanded. We were stuck at home. But now demand for services is rising quickly, while the demand for goods has started to moderate. A July analysis by supply chain firm Flexport found consumer preference for goods has started to decline. This period of inflation could end by the middle of 2023, Hogan estimates. We're seeing prices come down and that will help shorten the inflation cycle, he says. Both shipping costs and times have come down considerably. The decline may occur gradually as higher inflation for housing and healthcare along with food and energy prices will slow down the drop. Healthcare and housing costs usually add up to a large percentage of bills that consumers pay. Determining how long inflation will last is tricky, says Guy LaBosse, Chief Fixed Income Strategist and Portfolio Manager at Janney Montgomery Scott, a Philadelphia-based financial institution. The road from here to there is messy and it is hard to guess where services spending is going to go, he says. We are really bad at predicting inflation. What happened after previous periods of high inflation? The economy can rebound after periods of higher inflation. However, inflation can also precede a recession, which was the case in the 1970s. After inflation ended from the 1979 to 1980 and 1981 to 1982 cycles, the stock market went on one of the longest bull market runs with a brief crash in 1987, Hogan says. There was great economic expansion, he says, as the GDP and the number of jobs rose. Economists are increasingly predicting the U.S. will enter into a recession as growth slows, but estimates tend to agree that if a recession takes place, it will occur in 2023. Raphael Bostic, president of the Federal Reserve Bank of Atlanta, told NPR in late July that the U.S. economy is a ways from a recession and cited strong job growth data that is providing momentum in the economy. Treasury Secretary Janet Yellen has said the U.S. is not in a recession, but in a state of transition. When you look at the economy, job creation is continuing, household finances remain strong, consumers are spending and businesses are growing, she said during a July 28 press conference. This optimism was backed up by an unexpectedly sunny jobs report, which showed more than 500,000 jobs were added in July. Factors impacting high inflation rates. One thing that can influence what happens to the economy after a period of high inflation is what caused the inflation in the first place. The sources of inflation occurring currently are vastly different from the 1970s, LaBosse says. One of the major sources of inflation in the 1970s was an excess supply of money. Other factors included demographic pressures that don't exist today. Post-war family formation and the baby boom in the 1940s and 1950s resulted in a huge increase in demand for consumer goods, LaBosse points out. Data shows that 80% of people watching my videos are not subscribed. Remember, subscribing is free, it only takes a couple of seconds and you can unsubscribe at any time. Please help me and my channel by subscribing. Now back to the video. The current economic cycle will be impacted by the number of people active in the workforce, because it will affect the amount of production of various items such as electronics or vehicles, Hogan says. When suppliers can pick up their production levels, prices will come down, he says. China, which has a strict zero-COVID policy, also reopened factories recently, which may result in an increase in production of consumer goods. Meanwhile, demand for goods has already started to level off, with people holding off on buying discretionary items as predictions of a recession in the future increase. Consumers are less confident about making purchases. Nearly 7 in 10 respondents said they were more concerned compared to 6 months ago, according to a recent Forbes Advisor Ipsos Consumer Confidence Biweekly survey. In the coming months, consumers can expect to see a break in housing and energy costs such as gasoline, Hogan says. This reprieve has already started. Gasoline prices, which are set by the global market and depend on oil refining costs, have declined for more than 50 consecutive days. As of August 8, the average price for a gallon of gas is $4.06, a steep decline after hitting a record of more than $5 a gallon in June. And the average rate for a 30-year fixed-rate mortgage dropped below 5% on August 4, the lowest rate in 4 months. As a large number of people bought homes starting in 2020, the supply of homes being sold shrunk while prices rose exponentially. But home prices have started to decline. About 60,000 home purchase agreements were canceled in June alone, according to an analysis by Redfin. The number of cancellations marked the largest number of housing contracts that fell through since COVID-19 hit in the spring of 2020. Home buyers may be able to use these cancellations as an opportunity to negotiate for lower prices. The slowdown in housing market competition is giving homebuyers room to negotiate, which is one reason more of them are backing out of deals, says Taylor Marr, deputy chief economist for Redfin. Buyers are increasingly keeping rather than waiving inspection and appraisal contingencies. That gives them the flexibility to call the deal off if issues arise during the home buying process. As for other industries, the surge in inventory and durable goods such as washing machines and smaller appliances will likely result in prices falling in those sectors, LaBosse says. Prices for cars and trucks could decline, but it is a mixed bag, he says. Auto manufacturers are still facing supply chain issues such as being able to obtain enough semiconductor chips. As more new cars are available, it should both stabilize the number of available used cars and cause used car prices to drop, LaBosse says. As the supply chain improves and interest rates rise from the hikes by the Fed, inflation is anticipated to decrease slightly. Consumers will start to see a reprieve in energy costs such as paying less at the pump and will shell out less money for food.